Hello, I'm Brady Welch. I am the co-CEO and one of the founding partners of Slate Asset Management. Slate Asset Management is a global alternative investment and asset management platform with offices in Canada, the United States, and in Europe. We've been in business for 20 years. We have approximately $9 billion US of assets under management, and we've been quite busy over the last 20 years. Very proud of the team that we've built. We've done in excess of 20 billion of transactions over 20 years, and we've organically grown. I'm Canadian. My brother and I started the business in 2005, initially here in Canada, and then grew to the United States, and then ultimately to Europe, where I relocated 6 years ago to help support the growth of our business in Europe. The way that Slate looks at essential real estate, and I think others are starting to understand, this is really, non-discretionary, necessity-based real estate that's critical for our tenants to operate their business. It's very hard to disrupt, by e-commerce or other factors. So the type of assets that we select and what we focus on are typically food related. When you understand grocery, it's a distribution business. Although it was always kind of categorized as retail, it's really about a perishable item that humans need, and in good and bad times, they operate, and humans need to be close to this, and I'll talk onto that. So it's really supply chain related to essential goods and services that humans need every day. And so grocery is a good example. Other food distribution centers, that's what we've been focusing on. When we look at the essential real estate sector, this is real estate that typically is quite defensive. The retention rates are close to 100%, 99%. As I said before, they're mission critical assets. If you take a look at a grocery business, their concentration, it's a tight margin business, it's market share. So if they're making money in that location, they don't leave that location. They lock up those sites for multiple years, and they're looking for landlords that are willing to co-invest on that property and that real estate with them to either modernize their store, build out their gross leasable area, or sometimes build new stores for the long term. And they're willing to commit to a long-term lease to do that, and that's how you create a lot of value. So, we have we've purchased over 1,000 properties in Europe. I'll just focus on Europe a bit. We currently own just shy of 500 assets in 6 different countries across Europe. And it's really the business plan that determines the risk profile you're in. So, for us, we have a core plus vehicle where, more stabilized long-term leased assets that are performing well, that organic growth of income over time. So, what we're looking for is, well-occupied assets in good locations in markets where there's good demographics like household income, employment, and those tenants need to be there. And so if you think about a grocery store, they need all of those stores to distribute the product. They will have the big distribution center, but they feed in, it's a hub and spoke into their stores. So during the pandemic, 90% of what was delivered to your doorstep came out of those local grocery stores. They need that real estate to operate their business, and they don't like to give up a location because they give up market share. So across all different asset classes of commercial real estate, I would argue that this asset class probably has the most defensive cash flows. And we have been investing in this asset class for over 20 years. to like 95% year over year, and we can show the NOI growth year over year because it's not just moving rents to market, because we focus on what we believe are rents that are below market, but in Europe, our leases are CPI linked. So when we went through that high inflationary period, we got the benefit of being able to pass through the CPI. So, sticky cash flows, very strong covenant tenants with growing NOI over time. So that's the kind of dynamic that we look for. And depending on what we're doing with the assets, we'll create, whether it's a value add opportunity where sometimes we might go and re-merchandise or reposition the assets, maybe grow the leasable area, or bring in some, I would say, other tenants that will complement the high foot traffic that a grocery store, produces. So those type of opportunities we look for, as well as what we're seeing in Europe today is that we've gone through a period where there's been less sale activity. There are assets that are at the end of fund life, where, LPs are looking to recycle and return their money. And those assets now, because of the effect of office and maybe developments that are harder to sell those assets, they will sell their cash flowing assets. And that has presented a great opportunity for us in the last 12 months, buying really good performing real estate that's just either stuck in a fund that needs to liquidate, or other large funds that have redemption queues where we can buy more opportunistically. So that seems, much more interesting, because today these are cash flowing assets, and in Europe, when we look at the cost of debt, from the US or North America to Europe, we're buying at like maybe 300 to 400 basis points of positive leverage. And it's pretty hard to do that in other asset classes today. I think what we're seeing now, unfortunately, are different operators that have other issues in their portfolios with other asset classes, such as office or such as developments. And I think over time they've marked assets down, and so the bid-ask spread is tightened, where we can buy much wider now at a going-in cap base, and these assets are actually highly financeable. So you're buying good, strong cash flow, and the banks understand the resiliency of this cash flow and like to lend on it. So where we can buy and where we could finance produces a very high cash on cash return for us. So, which generates better returns for a core plus vehicle or even a value add vehicle where we can buy and how we can finance. The opportunity, some of these assets have been kind of a little bit orphaned or maybe undermanaged, maybe undercapitalized, where you can kind of go roll up your sleeve, put some capital back into the assets in return for longer leases and moving rents to closer to market. And that's kind of the value add opportunity. In addition, sometimes we see an opportunity where it's not pure grocery and we can buy a mixed portfolio of different assets and maybe buy down our basis by selling out like non-grocery type of real estate or non-essential real estate, and that buys down our basis so we can own the kind of necessity-based real estate longer term. Our view is in Western Europe, which is where we focus, it's a very mature market in terms of our tenants. So these are very strong operators. They're typically, the grocery stores are family owned and they're very large. If you take a look at the top 25 retail distribution companies in the world globally, the biggest German grocery stores would be in the top 25. So they're very large, sophisticated operators. So we like the covenants. And then secondly, in Europe, the cost of financing, where we can buy and where we can finance, our all-in cost of financing today is like 3.5% to 3.7%. We can buy today kind of like seven cap. So you create a very strong cash on cash return versus other markets and other opportunities. So when we look at on a risk adjusted basis, you're buying strong cash flows that are very defensive and very resilient and very financeable. And we think there's upside in those rents to grow over time. And I think that retail, unfortunately, a lot of this real estate was always grouped as retail. And if we would have had this conversation 10 years ago, some people would, thought that I guess all grocery stores would be like everyone get their food by drones. That didn't happen. During the pandemic, all of our stores were open and operating. They were paying rent. And I think institutional capital is starting to see the difference from discretionary retail to non-discretionary retail. And because it is about distribution, yes, you can argue that like an Amazon distribution center is that an industrial building, but they sell to the end consumer out of that building. So it's like, what is industrial today and what is retail? But we like the real estate because it's close to all the rooftops. It's close to where people live. And that's what makes it work, and where we can buy it relative to where maybe logistics assets trade and how we can finance it on a risk adjusted basis just seems so much more attractive to us. And I think institutional investors are starting to see the difference and the opportunity. I think the answer is yes to that. And I believe, if we take a look at like more of a macro level, as people reduce their exposure to retail, they're underinvested in retail. And I think still people are concerned with e-commerce and the effect of retail. But now you've gone through a period where office has, gone through its perfect storm. And, multifamily with the cost of correction of just the underlying cost of capital. Those, even though they have good fundamentals, both of those logistics as well as multifamily, I think people are fully invested in those. And office being weak, they're probably looking where else, how do I shift my portfolios? And I think essential real estate fits very well because they're under allocated in the retail space. So I think, we're seeing the benefit of that capital flowing into this asset class that was always just grouped generally as retail. But I think that it's starting to bifurcate. And I think that this asset class will always be part of institutional capital's kind of portfolio as they build it out because of the stickiness, defensiveness of the cash flows. It generates, when you're making an investment in here, it's not a cap rate compression game. It's, you buy right, you grow the rents, the buildings stay well occupied, they're well located, close to where growing communities are, where people live and work every day. So I think that's what makes it attractive to institutional capital.